Imagine overpaying your income taxes by, let's say, 10,000 pesos right out of your own paycheck.
Oh, which hurts. Just thinking about it hurts.
Yeah, it hurts a lot. But then when the end of the year rolls around and you go to file for a refund, the government legally pockets the money. They refuse to give it back and basically tell you to walk away.
Yeah, I mean, that sounds like a glitch in the system, right? Like a mistake.
Exactly. It sounds totally wrong.
That-
But if you mess up one specific piece of paperwork with your employer, that isn't just some nightmare scenario. It is the actual law under Section 80 of the tax code.
It is a brutal rule. And
Mhm.
honestly, it's exactly the kind of high-stakes scenario that examiners love to put on the Philippine CPA board exams.
Oh, they love it.
They really do. So today's mission for this deep dive on ICPA Review Radio is to help you master Sections 78 through 83. We're talking about income tax collected at source, which you probably know better as withholding tax on compensation.
Right, because examiners don't just want to know if you can, memorize and calculate a basic tax rate.
No, that's too easy.
Way too easy. They want to test if you actually understand the traps, the exceptions, and the strict administrative deadlines. Basically, the stuff that bridges theoretical tax concepts with real-world compliance.
Precisely. Because think about it, the Bureau of Internal Revenue, the BIR, they rely heavily on employers to act as their primary tax collectors.
Right.
And this creates an absolute minefield for multiple choice questions, or MCQs, on the exam.
Right.
The rules are super rigid, the timelines are unforgiving, and the penalties for a CPA getting them wrong in the real world are, well, they're severe.
Yeah, no pressure, right? But hey, you've got this. We can't withhold tax if we don't even know what we're taxing, though. So let's start at the very beginning with the exact legal definition of wages under Section 78.
Good place to start.
But I want to look at this a bit differently. Let's imagine the definition of wages is like a VIP list for a very exclusive, heavily taxed nightclub.
Okay, I'm listening.
The examiners, they aren't usually testing who gets into the club. Like, that's obvious. They want to test who the bouncer kicks out at the door.
I actually really like that analogy. So under Section 78, wages essentially means all remuneration for services performed by an employee for their employer.
Right.
And here's a crucial point for the exam, something you need to remember. This includes the cash value of all remuneration paid in any medium other than cash.
So wait, if an employee is paid in, like, company stock.
Yes, company stock, a car, or even a month's worth of groceries. The fair market value of those non-cash items gets past the bouncer. They are considered part of the wages for withholding purposes.
Okay, so the bouncer lets in almost everything, whether it's cold hard cash or a literal car. So who actually gets bounced to the exempt list?
Well, there are 4 strict exceptions laid out in Section 78, and a lot of reviewees use the mnemonic ADCF to remember them.
ADCF. Okay, let's put that to the test with some exam scenarios. Let's say I run a farm, right? And I have a worker whose entire compensation is a portion of the rice harvest. Does the bouncer let that into the taxable club, or is it exempt under the A in ADCF?
That gets bounced right to the exempt list. A stands for agricultural labor. But, and this is a massive caveat that you must highlight in your notes right now,
Got your highlighters ready, folks?
it must be paid entirely in products of the farm where the labor is performed. Entirely.
Entirely, not mostly.
Exactly. And it helps to understand why this rule exists. Imagine the administrative nightmare for the BIR if they required an employer to withhold a cash tax based on the volatile, fluctuating market value of a sack of rice every single month.
Oh, that would be a mess.
It's too messy, so it's exempt.
But examiners love to mess with that, don't they? What if I pay that same agricultural worker, say, 90% in rice, but I give them just 100 pesos in cash as a little bonus?
Boom, then the bouncer pulls them right back into the taxable club,
Just for 100 pesos?
just for that. If there is even 1 centavo cash involved, the exemption breaks completely. The entire remuneration, so the rice and the cash, becomes subject to the general withholding rules.
Wow, okay, that is a classic MCQ trap right there. Context and absolute purity of the payment method matter. So let's look at another scenario for the D in our mnemonic.
Okay, lay it on me.
What if I hire someone to clean my personal residence every week versus hiring that exact same person to clean my accounting firm's office?
Right, so the law treats your private home and your commercial business as 2 completely different tax universes.
Interesting.
Yeah. D stands for domestic service in a private home. So the cleaner at your personal house gets bounced to the exempt list. There is no withholding tax on their compensation.
But what about the office?
Well, the moment they step into your accounting firm or, say, a hotel you own, they are no longer providing domestic service in a private home. That becomes a regular taxable wage.
So the law is essentially forcing the employer to differentiate between their personal life and their trade or business.
Exactly.
Which brings up an interesting edge case for the C in our mnemonic, right? What
Yeah.
if a law firm hires a plumber to fix a leak, not at the office, but at the senior partner's private home?
Right, the plumber isn't an employee of the firm.
Exactly, and plumbing has literally nothing to do with practicing law.
That perfectly describes the C exception. Casual labor, not in the course of the employer's trade or business.
Ah,
Because it's an odd job completely unrelated to the firm's primary operations, it is exempt from this specific withholding tax.
perfect. And rounding out the mnemonic, we have F.
Yeah, so F is for foreign government or international organization services provided by a citizen or resident of the Philippines.
And that's just because of diplomatic immunity, right?
Exactly. Because of diplomatic immunity in international treaties, the Philippine government simply cannot force a foreign embassy or an entity like the United Nations to act as a withholding agent for the BIR.
All right, so our bouncer kicks out agricultural labor paid entirely in crops, domestic service in a private home, casual labor outside the course of business, and foreign governments.
That's ADCF.
But I have to push back here because, well, the real world is messy. What if an employee does a mix of things?
What do you mean?
Say they work for me, and in a single month, they do 10 days of covered taxable work at my firm, and then they do 10 days of exempt casual labor at my house.
Okay. This is exactly where Section 78 introduces the 50% rule, and you need to read the mechanics of this very carefully for the exam.
Okay, to break it down.
First, it only applies to a payroll period of not more than 31 consecutive days. Think of your standard semi-monthly or monthly payroll.
So if a problem throws a 60-day project at you, this rule doesn't apply at all. We are strictly looking at 31 days or less.
Correct. Within that maximum 31-day period, if the remuneration paid for services during one half, meaning exactly 50% or more of that period constitutes taxable wages, then all the remuneration for that entire period is deemed to be wages.
Every single peso.
Every single peso.
It's like a 50% payroll seesaw. Whichever side the majority of the days fall on, the whole period tips that way. It's an all or nothing rule.
Exactly. But listen to the specific phrasing, one half or more. Examiners love testing a perfect 50-50 split to see if you actually read the text.
Oh, that's sneaky.
Right. If an employee works exactly 10 days doing taxable work and exactly 10 days doing exempt casual labor, the seesaw tips toward taxable.
Because it hits that one half mark.
Yes. It has to be more than one half of exempt work to tip the seesaw the other way and make the whole period exempt.
So if it's a tie, the government wins and taxes the whole thing.
Basically, yeah.
That is such a crucial nuance to catch for a computational question. You have to watch out for that. Okay, so now that we know what a wage is, we need to know how to compute the withholding.
Right, the actual math.
Yeah, and reading through Section 79, the computation seems to depend heavily on the employee filing their paperwork correctly.
It absolutely does, and it starts with the withholding exemption certificate. The law dictates a very strict timeline here.
How strict?
An employee must furnish the employer with this signed certificate on or before the date of commencement of employment.
So not a week later when they finally get around to it. Day one or earlier.
Exactly. But, you know, life happens. People get married, they have kids, their dependents change over time.
Right, so what happens then?
When that happens, the clock starts ticking immediately. In the event of a change of status that affects their exemptions, the employee has exactly 10 days from that change to file a new certificate with the employer.
Just 10 days. Okay, let's bring this back to the terrifying scenario we opened the deep dive with.
Oh, the forfeiture trap.
Yeah. What happens if the employee is just stubborn? Like they refuse to file the certificate, or worse, they willfully supply false information on it to try and game the system.
This brings us to Section 80
Yeah.
and the brutal penalty we mentioned earlier. If an employee fails or refuses to file the certificate, the employer doesn't just guess their status.
They don't just eyeball it.
No, the employer is legally mandated to withhold taxes using the schedule for zero exemption.
Meaning the employee gets taxed at the absolute highest possible baseline for their income level. No deductions for dependents, no safety net.
Exactly. And here's where the forfeiture rule kicks in. Usually in tax law, if too much tax is withheld during the year, you eventually get a refund or a tax credit when you file your annual return.
Right. That's how it normally works.
But Section 80 explicitly states that if excess taxes are withheld specifically because the employee refused to file the certificate or gave false information, that excess shall not be refunded.
Wow.
It is completely forfeited in favor of the government.
I mean, why is the law so aggressive here? It feels like the BIR is just stealing their money.
I get that, but it's highly punitive by design. The BIR doesn't have the manpower to chase down millions of individual employees for correct paperwork.
Oh, that makes sense.
So they create a consequence so severe that employees essentially police themselves. If you lie or hide your status, you lose your money forever. A board exam MCQ might ask. Employee X refuses to submit his certificate. At year-end, 10,000 pesos in excess tax was withheld. How much can employee X claim as a refund?
And the trap answer is 10,000. The correct answer is 0. That is a devastating mistake for a taxpayer, but an easy point for a CPA candidate who knows the rule. Speaking of exemptions, there's another default rule in Section 79 that feels a bit outdated, but it's a staple of the board exams. It involves married couples who are both receiving wages.
Ah, yes.
Yeah.
You're talking about who gets to claim the dependents. By default, the law deems the husband as the head of the family and the proper claimant of the additional exemptions for dependent children.
And this is just an automatic setting in the tax code.
Yes, it is. It stems from historical tax code structuring based on traditional single-income households.
Yeah.
While society has obviously evolved, this rule stuck around as a mechanical application for withholding purposes.
So the husband just gets it.
The husband gets the exemptions automatically, unless he explicitly waives his right in favor of his wife, and he has to do that right there on his own withholding exemption certificate.
So if you get a computational problem on the exam featuring a married couple, and the problem is completely silent on any waivers being signed, you have to apply that default setting. The husband's withholding is calculated with the exemptions, and the wife's withholding is calculated using the 0 exemption schedule.
Exactly. Don't overthink it or assume they split it 50-50. If the problem is silent, husband gets it, wife gets 0.
Okay, we've got the definitions down, we've got the computation defaults down, but here is where the rubber really meets the road for a practicing accountant. It's the administrative deadlines.
Called the deadlines.
Because withholding the money is only half the battle, right? We actually have to remit this money to the government.
Right. And before you can finalize everything at the end of the year, you have to perform what is outlined in Section 79 as the year-end adjustment. Most accountants call this the true-up.
Let's walk through this true-up process step by step, just like we're solving a simulation on the exam.
All right, let's do it on or before the end of the calendar year, but strictly prior to paying out the compensation for the last payroll period.
So before you hand out that final late December paycheck.
Right. Before that check goes out, the employer must do a major reconciliation. Step 1. Calculate the actual true income tax due from that employee for the entire taxable year from January 1st to December 31st.
You find the true annual tax liability. Got it. Step 2.
Step 2. Compare that true annual liability against the sum of all the taxes you already withheld from January through November. Because withholding tables are estimates, there will almost always be a discrepancy.
Okay, so what if you didn't withhold enough?
If you didn't withhold enough throughout the year, you deduct the shortage from that final December salary. But if you withheld too much, the employer has to refund the excess to the employee.
And this brings us to a concept I like to call the dueling deadlines.
Oh, examiners love this.
This is where easy points slip through candidates' fingers because they read the question too fast. When exactly does that cash refund have to be given to the employee?
The refund for the year-end adjustment must be returned to the employee no later than January 25th of the succeeding year.
January 25th. Lock that specific date in your mind right now, because there's another date looming right behind it, but it deals with paperwork, not cash.
Correct. Under Section 83, the employer must furnish the employee with a written statement confirming the exact wages paid and the taxes withheld for the year. That's the famous BIR Form 2316.
Right.
Furthermore, the employer must submit an annual information return to the BIR commissioner. Both of those paperwork requirements are due on or before January 31st of the succeeding year.
So the examiner will give you this lengthy scenario, and at the very end, ask for the deadline. You have to pause and identify what exactly they're asking for. Are they asking when the cash refund is due to the employee?
That's January 25th.
Or are they asking when the written statement or the annual return is due?
That's January 31st.
Cash on the 25th, paper on the 31st.
It's a brilliant way to test attention to detail. And if we pull back and look at why these rules and deadlines are enforced so aggressively, we hit Section 81.
Okay, what's Section 81?
This section contained a vital concept for both tax law and financial accounting. It states that all taxes deducted and withheld by employers shall be held in a special fund in trust for the government until they are paid to the collecting officers.
In trust. I mean, that isn't just casual phrasing. In law, that is an incredibly loaded term.
It changes the entire ownership dynamic. It means this money does not belong to the employer, not even for a split second.
Wow.
The moment that tax is withheld from the employee's gross pay, it becomes government property. The employer is merely a custodian holding it in trust. This is the foundation for why Section 80 imposes strict personal liability on the employer.
Let's explore that liability. What happens if an employer just makes a computational error and fails to withhold the right amount? Or, what if a business is struggling with cash flow and they decide to temporarily use those withheld trust funds to pay rent, planning to put the money back before the quarterly remittance deadline?
Commingling trust funds with operating accounts is a massive ethical and legal violation. If the business goes under before they remit that money, the liability doesn't just disappear. The employer is personally liable for the correct amount of tax, plus hefty surcharges and interest.
But wait, what if the employer fails to withhold, but the employee is an honest taxpayer?
Okay.
The employee files their own annual return and pays that missing tax directly to the BIR. The government got their money eventually, so is the employer off the hook?
No, and this is a twist that exams love. The tax itself won't be collected twice, obviously. Yeah. But Section 79 is crystal clear. The employer is still liable for all the penalties and additions to the tax that applied to their initial failure to withhold.
Even if the tax was paid?
Even then, the act of failing to act as a proper withholding agent is a penalized offense all on its own.
Because the BIR deputized the employer. If you drop the badge and fail your duty as a tax collector, you pay the price, regardless of what the employee does later. It really makes you respect the mechanics of these sections. It's not just academic theory. It is serious operational liability that can bankrupt a company if handled poorly.
Absolutely.
Yeah.
Which is why mastering this topic isn't just about shading the right circle on a Scantron sheet. It's about protecting your future clients or your future company from devastating financial penalties.
We have covered some serious, highly testable ground today. If you are walking into that testing center tomorrow, we want to make sure these concepts are fresh. So let's wrap this up with our exam day checklist. Here are the 4 must-remember takeaways you need to have locked in for withholding tax on compensation. Ready?
Let's hear them.
Number 1, the ADCF exceptions to the taxable VIP club. Remember that agricultural labor must be entirely in farm products, and domestic service must be in a private home, not a business. Number 2, the 50% seesaw rule. This applies to mixed payroll periods of 31 days or less. If exactly half or more is covered wages, the entire period is taxable. It's all or nothing, and a tie goes to the government.
Crucial point there.
Number 3, the zero exemption and forfeiture penalty. If an employee fails to file their exemption certificate or lies on it, you withhold at 0 exemption, and any excess withheld is forfeited to the government. 0 refunds.
None.
And finally, number 4, the dueling deadlines trap. January 25th is the deadline for year-end cash refunds to the employee. January 31st is the deadline for the written statements and annual information returns. Cash on the 25th, paper on the 31st.
That is a solid exam-focused checklist. And before we go, I want to leave you with a final scenario to mull over, one that combines a few concepts we discussed today.
Okay, lay it on us.
We know that non-cash remuneration, like company stock, is considered a taxable wage based on its fair market value. And we know that the withheld taxes are held in trust for the government. So think about the mechanics of this. If an employer pays a massive bonus in company stock, they have to withhold a portion of that value as tax. But what if the employer holds on to that stock in trust, intending to remit its cash equivalent to the BIR later? But the stock market crashes before the remittance deadline.
Oh, wow.
Yeah. How do you remit trust funds to the government when the value of the asset you held has suddenly evaporated? The tax code is full of these structural tension points, and understanding them is what turns a good candidate into a great CPA.
That is a terrifying thought for a corporate accountant and a brilliant puzzle to think through. Remember, when you're staring down these MCQ minefields on exam day, don't let the pressure get to you. Just look for the rules, spot the traps we talked about today, and trust your preparation.
You have put in the hours, you've done the reading, and you know the mechanics. Keep pushing forward.
Best of luck on your upcoming CPA board exams, and thanks for tuning into this ICPA Review Radio Deep Dive. We'll see you on the other side.